David R. Guttery is the president of InSource Financial Advisors in Lincoln, Nebraska. David Guttery and Seth Edgell are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of this video for additional important disclosure information.
Hello everyone. Today I'm joined by David Guttery, president of InSource Financial Advisors, to share his thoughts about a changing economic season. David, thanks so much for being with us today. Well, within our last interview, you offered your thoughts about the potential for changing economic seasons in 2024. And as we've discussed in the past, this will likely happen in fits and starts. Can you elaborate on this for our viewers and describe what you're observing to this point in the year?
Absolutely. Indeed, straight lines do not occur in nature. Let's observe the weather that we're having right now, for example. As we emerge from winter into spring, you know that we'll have a string of days where the temperature is in the mid-70s. The sun is shining and we begin to see green on the trees again. And then Mother Nature throws another 30-degree curveball at us with a late season freeze. Look, we know that the Earth tilts 23.5 degrees on its axis. It is this tilt that provides our seasons. We are indeed moving toward the summer solstice. One late season freeze does not mean that we're headed back into winter. Likewise, emerging from economic winter into economic spring will also bring with it some metaphorical cold snaps along the way. In my opinion, I remain convinced that we are indeed emerging into a new, warmer economic season, and I believe that there is plenty of data to support this conclusion. So being tactical in our approach to asset allocation, we have to be stoic and dispassionate as we evaluate these metrics and have the intestinal fortitude to proactively move on compelling data.
Well, I'm sure our viewers are eager to hear about these metrics. So David, can you elaborate on these metrics and help our viewers understand what you find to be compelling about them?
Sure. Why don't we begin with consumer confidence? In just the last few months, we've seen quite a rebound in the confidence of consumers, as evidenced by the University of Michigan's Consumer Sentiment Survey. Now, as we've discussed in previous videos, this metric hit an all-time record low reading in November of 2022. With inflation fresh off of a 40-year high and personal income rising at a declining rate, it was easy to see why. We had never felt more dour about our capacity to spend than we did in November of 2022. Then gradually, marginally, painfully, we emerged from that low point. But notice that late in the prior year, we had begun to see increasingly higher readings for this metric. Indeed, in December, January, and again in February, we saw the three best months for this metric since July of 2021. So attitudes toward consumption are changing in a positive way and quickly. Why might this be happening? Well, we felt dour in 2022 because our capacity to spend was under inflationary duress. Today, it appears that the rate of inflationary change has nearly returned to pre-pandemic levels. According to the Department of Labor, the year-over-year change in personal income has been higher than that of the rate of inflation. So our capacity to spend has been increasingly positive since November of 2022. Discretionary income has been increasingly plentiful as well, and hence why we're observing patterns of consumption improving. Aside from sequentially higher retail sales reports, we are also being able to see a discernible shift in the ISM Manufacturing Index. The ISM Manufacturing Index had been in free fall since March of 2021 until the beginning of the fourth quarter last year. Manufacturers didn't just decide to stop making things, they responded to you not buying as many things as inflation hit a 40-year high. That, in my opinion, gave rise to the recent crisis-driven, rapid adoption of technology and the emergence of these Magnificent Seven stocks last year. We'll save that for another video. For now, notice that this trend came to an end in the fourth quarter of last year and has seemingly reversed. Now, for the first time in well over a year, the index is above 50, which indicates expansion. Clearly, the consumer is buying more things now. And this is important because consumption is 70% of gross domestic product. And observing these points of data, you can see how they're beginning to daisy chain together. And in my opinion, they're pointing to a much better outcome than we had anticipated even just 1 year ago. We must be stoic in our resolve to proactively manage portfolios in a tactical manner as we're observing changes in such data.
Wow, you're right. It's interesting to see how these metrics seem to confirm that the economy may be on more solid ground than we previously thought. Well, David, you've talked in the past about observing market behavior as an indicator as well. At this point in the year, what can you tell our viewers about market sentiment as a function of behavior?
Yes, we call that stochastic analysis. So when you hear in the media that markets are bouncing off of strength or running into resistance, it is two Bollinger Bands that reference is being drawn. On the 20th of November, it appeared that the 50-day and the 200-day moving average were converging within the same cone. So on its surface, this suggested that the first quarter of 2024 might be very interesting to watch. On the 1st of December, though, we received the minutes of a Federal Open Market Committee meeting, and in my opinion, we heard the same message for a 13th month in a row from the Fed. Over the previous year, markets didn't metaphorically blink, still reluctant to fully embrace the Fed following the most aggressive removal of accommodation that we'd seen in 45 years. But on this day, the markets closed up 580 points. We broke through what had been the upper level of resistance. Statisticians will tell us that if you breach a barrier, higher or lower, close above or below that level, and continue the trend, then there is a statistically high probability that you will reset that barrier 10 to 15% higher or lower than the previously breached level. Well, here we are today. We're still searching for what has yet to become that new upper level Bollinger Band of resistance. So to your point, yes, I can point to a stochastic analysis of the market to suggest that we are indeed seeing patterns of behavior seemingly changing in a positive manner for the first time really since the pandemic.
Well, thanks for that explanation, because data like this probably escapes many people in their everyday lives. It's reassuring to hear your explanation and thoughts on what data such as this might be telling us. So in closing, what high-level advice can you share with our viewers about how they should approach this year as investors?
Well, that's easy. Be this guy. Stay away from sensationalism and hyperbole. Remain focused on that which can be quantified, and find the stoic disposition to act upon data when it begins to point in a certain direction. Remain focused on the fruition of planning goals and not necessarily on the red or the green arrows of the day. Most of all, be patient. Yes, I believe that we're headed for the summer solstice, but you know, August doesn't immediately follow April. This will unfold gradually and over time and across fits and starts, as you put it in the beginning of the video. Remain patiently focused on the bigger picture. Be tactical in your approach to asset allocation while keeping your intestinal fortitude intact. That is how we get through periods of disproportionate upheaval.
Well, David, as always, thanks so much for this information. And for additional information, David may be reached through the means listed upon the following screen. For InSource Financial Advisors, I'm Brannon Dawkins.
David Guttery and Seth Edgell independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.